Hey, what's going on, guys? Welcome back to my channel, The Smoking Beard. Today I want to go over understanding your credit score. Before I do that, please don't forget to like and subscribe. Alright, so your credit score. How does this thing work? To begin with, there's 3 reporting companies. These are the companies that your creditors are going to go check your credit score to see if you qualify and for what interest rate. Alright, so these 3 companies are Transunion, Experian, and Equifax. Depending on which company or which lender is going, they might use 1, they might use 2, or they might use all 3. But these are the guys who are the gatekeepers of your credit. Now, these guys factor in a lot of things to produce your credit score, and that's what I want to go over, understanding it. Okay? So to begin with, your credit score ranges from a 300 to all the way to an 850. And if you look at this chart, you're going to notice that poor credit scores are from 300 to 579, which is about 16% of the population. Fair, 580 to 669. Good, and that's actually here 17% of the population. Then we have good credit scores, 670 to 739 at 21%. Then you have very good credit scores at 25% of that is 740 to 799. And of course your exceptional, which is your high-end credit scores, are 800 to 850. All right. If you fall between this 800 to 850 and 740 to 799, you're pretty much guaranteed the lowest rates out there available for you. Your rates start to jump once you fall under good, fair, and poor. And I'll go over a little bit of what that means. Why should you protect your credit score? There's very, very critical reasons of why you should protect your credit score. Your credit score is something that's going to affect you for the rest of your life. So by understanding it right now, it'll help you get on the track to get the best score possible. First of all, a higher credit score can save you money. And what I mean by that is that the higher the credit score you get, the lower of an interest rate that a bank is willing to offer you. Now, sometimes you ask why. Why is the credit score the one that affects my interest rate? Well, your credit score is almost like considered like a risk factor. So the higher your score is, that tells the people who are trying to give you credit that you're less of a risk. The lower your credit score, you're at a higher risk of not paying back. So when a credit company sees your credit score, and whether it's good or bad, they're gonna base your interest rate on your risk factor. So if you have a high credit score, they're gonna be like, well, this guy or this gal pays their credit, so we don't have that high of a risk of lending them this money, so we're gonna go ahead and lend them at a lower interest rate. Okay, so to begin with, it saves you money. The other thing, and this really, it doesn't really affect you on a credit card because credit cards are normally the same really high interest rate. There are some credit cards you can qualify for a lower interest rate, but for the most part, when I say afford more for less, it really deals with big ticket items like a home or an auto purchase. Okay, so if you walk into I'm going to use an example of a car dealership. If you walk into a car dealership and you're going to get this car that's, let's say, $25,000 purchase, if you have a high credit score, you're going to get a very low interest rate, which means that your payment is going to be lower. But if you go into that dealership with a low credit score, that same $25,000 loan is going to cost you a lot more. So that person who walked into the dealership with a higher score can afford that $25,000 vehicle, but you, or if you walk in with a low credit score, maybe you're gonna be able to only afford a $20,000 vehicle, which means either you get the lower model of that line or you go to a lesser vehicle just to be able to afford it. This has nothing to do with the vehicle itself, but it deals with your ability to pay back and also your risk factor. So they're willing to give that vehicle to that person at a lower interest rate because they're less of a risk, but for the other person, they're going to give them at a higher interest rate because it's a higher risk. So you can afford more for less. And also, you should protect your score because you are in control. If you walk in to look for credit and you know you have a good credit score, you're not gonna, if they offer you a high interest rate, you can easily say, I don't think so, I'm gonna go look somewhere else. Now, if you walk into the dealership with a really bad credit score, you're gonna take whatever offer they give you, because in your mind, you're thinking, well, at least I'm getting it financed, right? You should never walk into a dealership or never walk into a refinance of a mortgage or a mortgage with that mentality of, well, at least I got credit. You should go in there saying, I know my credit score, I know how high it is, I know what I can afford, and I know what I'm entitled to. So you're gonna match my expectations instead of the other way around. So this is why it's very, very important to protect your credit score. In the end, all this translates to saving you money. All right, now you go into the, okay, so now I'm interested, I want to protect my credit score, but what are the factors that these companies, the Transunion, the Equifax, and Experian, what do they look at, or how do they come upon my credit score? They don't just pluck it out of the sky, right? So I'm gonna go over your risk factors and letting you know what is a risk factor, or what are the main risk factors that they look at, and I want to also explain each one individually. Okay, first of all, the ones I'm going to go over right now are low impact to your score. They will impact your score, but they won't impact it greatly. It'll be impacted minimal. First of all, hard inquiries. Now, what is a hard inquiry? A hard inquiry is when you ask for credit and that company goes and checks your credit report. Okay, so if you do that a lot, like let's say you walk into Kohl's and they say, hey, it's $150, but if you apply for a card, we'll give you 30% off. And you apply for the card, that's a hard inquiry. Okay. Now there are times when credit card companies themselves will automatically check your credit to see how your credit score is, to either increase your credit line or give you a lower interest rate. Those are soft inquiries. Those do not count against you. It is only when you ask for credit to be pulled on you. Okay, that's low impact. And the next one is the amount of accounts open. So if you go to Kohl's, if you go to Best Buy, if you go to Walmart, if you go to any retail store and everybody's offering 10%, 15%, 20% off if you apply for their credit, this impacts you in two ways. First of all, each one of those inquiries is going to affect you as a hard inquiry, but also how many accounts do you have open? So when the credit company looks at your credit to factor your credit score, they're going to look at how many accounts you have open, and this becomes a liability, because if you have way too many accounts open, what's to stop you from going and just maxing out all your credit cards and not paying anything back? So it's kind of like a risk factor. Okay, so just so you know, these hard inquiries, when these happen, if I apply for credit today at Home Depot or at Lowe's or wherever it is, that hard inquiry will not be removed from my credit score for 2 years. So whatever you decide to apply for will be there at least for 2 years, and the more you apply for within the 2 years, the higher your hard inquiries become, and if your account gets approved, the more accounts you'll have open and have the ability to use that credit. Okay, so these are low impact. So unless it's a really good deal, you might want to start looking at credit card offers like, is it really worth lowering my credit score? Okay, so just keep that in mind. The next phase is your medium impact. These have a little bit more weight. This type of impact has a little bit more weight on your credit score. Okay, so your age of credit history. Now this one was one that I just learned. I mean, I wish I knew this a while ago. Okay, so your age of credit history means how long have you had credit? So I'll give you an example in my instance, or my example. Sometimes I would apply for credit and they would approve me, right? But then they would send me a letter and saying, well, we based our decision on X, Y, and Z factors. And one of the negative ones that always came out was your age of credit history. And this always confused me. I was like, what do you mean my age of credit history? I've had credit since I'm 18. So I should have about 20 some years worth of credit history. That's not how they factor it. This is where it was like mind blowing to me. So this is what your age of credit history means. So you walk in at age 18 and you apply for a credit card. One credit card, age 18. If you really think about it, at age 19, you would think that your age of credit history is 1 year. But that's not the case. The way it works is you walk in at age 18, you apply for, let's say, Lowe's credit card. You get approved. So your age starts at age 18. But then you go into, let's say, Walmart 6 months later and you apply for their credit card and you get approved. And you would think at that point you have 6 months of age of credit. But that's not the way it works. Because you have 2 credit cards open now, they divide your 2 credit cards divided by the 6 months, and now your age of credit is 3 months. Even though you've had credit since you were 18, 6 months into it, you have 2 credit cards, now it's 3 months of age. Let's assume on your birthday, on the following year, when you're 19, you go to, Hobby Lobby, and you apply for their credit card. And you get approved, right? It happens all the time, especially when you're young. Hey, you want credit? Go ahead, take it, right? So you are under the assumption that at age 19 now, you're 1 year after you applied for your first credit card, your age of credit should be 1 year, but that's not the case. Because you applied 3 times and you have 3 open credit accounts, that means that in that 1 year, they divide the 3 accounts divided by the amount of years. In this case, it's 3 accounts divided by 1, right? So now your age of credit, instead of being 1 year, now it's 1/3. So it's about 4 months. So when I look at my credit report, I would always have my age of history as like 4 years, 5 years. It's like, that does not make sense. I've had credit since I was 18. I should have 20 years of age. Well, the problem was that I would open up so many accounts that they get the amount of accounts that are open and divided by the amount of time, and that's how they figure your age of credit history. So just be very careful with that, because this has a medium impact, not the high impact, but has a medium impact on your credit score. So I'm not saying don't open up credit. I'm just saying be more selective in the credit that you open, because this one will affect you in the long run. It doesn't seem like it, but it will affect you in the long run. Also, let's say you're 10 years from now and you already have established credit and you never use your credit card that you first opened up 10 years ago, and you decide, you know what, I'm going to go ahead and close that account. Don't do it. Do not close, especially your oldest accounts. Don't close them, because those accounts are helping you extend your age of credit. So if you have, let's say, 5 accounts and you close one of them, it's gonna shorten your age of credit, especially in the amount of time. So keep the accounts open if possible, but don't open up new accounts if not necessary, because that automatically brings down your credit, your age of credit. That one was like the major one that I was never explained, and I had to learn the hard way. Okay. All right. So high impact. These are going to affect you tremendously. So these are the ones you have to really focus on. First of all, derogatory comments. These are basically you did not pay. The more times you don't pay, the more times they report you to the credit agency, and the lower your score. You're 30 days late, you're 60 days late on your credit card, on your retail store card. Every time you do that, they're going to send a derogatory comment into your account saying this person did not pay on time. This person did not pay on time. Also, the health industry can also affect you. If you go to the doctor and you owe them for a visit that you haven't paid for, they can report you to the credit report agency and they will leave a derogatory comment. These are not like your hard inquiries up here that take 2 years to come off. These, if you don't fix it, they can stay in your credit from 7 to 10 years. So if you got in an argument with, your Walmart customer service rep for over a credit card and you're not going to pay it, guess what? That you might not be, they might not come after you for that credit amount that you owe, but they're going to leave a derogatory comment on your account that's going to last for up to 10 years. So that one will affect your credit score big time. This is what we talk about risk factors. So if I walk into a dealership, let's say I'm going in to buy a car and I have no derogatory comments, my credit score is going to be high because in my history, I have never been late or I always pay my debts. But if somebody else walks in with a lot of derogatory comments, that brings their credit score down lower because you're a higher risk. Kind of like a flight risk type of thing. So make sure you try to not be late or pay off your debts on time so these derogatory comments do not stay in your account for 7 to 10 years. Very, very important on that one. Your credit card utilization. So what does this mean? So this credit card utilization means if you have, and I'm going to make this round figures, but if you have 10 credit cards and each credit card has a $1,000 limit, in total, you have a utilization amount of $10,000. Each card is $1,000 times 10 is $10,000. Now, if you're the type that has $10,000 worth of available credit in credit cards and you owe $9,999 all the time, you're using 99% of your available credit, right? That is bad. That is bad because what that tells the credit reporting agencies is this person, as soon as they open up a credit card, they max it out, right? So what you want to have is you want to bring this utilization down to about 15 to no more than 20%. That's what affects you. It doesn't affect you in a bad way. So that means that if you have $10,000 in $1,000 in each credit card for a total of $10,000, you shouldn't owe more than maybe $2,000 combined in all your credit cards, so that your credit card utilization does not go above that percentage. Because if it does, it starts to become a higher and higher risk. Okay, so just be very careful. Not just because you have a credit card means you can max them all out. All right. And of course, your payment history. This has a very high impact. It goes back to the derogatory comments. This one hits you 2 times. If you don't pay on time, they're going to report you as a how many times have you been late. And if you don't pay, they also put you on derogatory comments that you did not pay. So just make sure you're always paying on time. If you're not going to be able to make your payment, at least try to call the company and try to work something out. Because if they put that you are late on your payments, that also affects your credit score. All right. So now you're like, okay, so how do I monitor all this? All this information that I'm giving you, I got it, and I'll show you which company I'm using to get all this information from. But this is free. You don't have to sign up for anything. This is given to you for free. Some of it is by law and some of it is by choice. Okay, so the very first one is your annual credit report. Now, this one was established about 10 years ago, more or less, 10 or 15 years ago, where you have the right as a consumer to request a credit report for your credit once a year. It doesn't count against you as a as a hard inquiry. And you can look for this through under it's called free annual report. And I have the website here. And I'll leave a link on the description below in case you guys want to go and get your own or access your own credit report. But this was done intentionally by the government so that we could look at our credit scores without having to pay for it or it affecting our accounts. Because there are some easier ways or some free ways of doing it. Is by applying for a credit card, they deny you, and then you ask to see your credit report because you want to see what's wrong, right? But you have to apply for a credit card to do that. This way, the annual credit report gives it to you once a year, and it gives you your credit reports for all 3 reporting companies. So annualcreditreport.com. I'll leave a link on the description below. The next one that I use a lot and is very, very user friendly. I check this almost on a daily basis, is your creditkarma.com. Credit Karma. This one will give you a very, very user-friendly way of understanding your credit score and how you can make it better, okay? And also, and this just depends on your banks. There are some banks and there are some credit card companies and there are some other financial institutions that if you have a credit card with them, if you have an account with them, all this stuff, they give you, sometimes they offer you free credit monitoring. So that would be something that you might want to look into if you do not want to go through the annual credit report, or if you don't want to use Credit Karma. But some banks will offer it to you as a service, or sometimes as a free service for you to keep track of your credit. All right. So I hope you learned something new today. Like, again, for me personally, the one that was a very big eye opener was the age of credit. That it doesn't mean that because you've had credit for 20 years, that's your age of credit. It depends on how many accounts you have open. That was like the biggest eye opener for me in all these scenarios. But I hope you learned something. If you did, please leave a comment down below. Again, don't forget to like and subscribe, and check out my other videos. Thank you guys for watching.